Hello, everyone, and welcome to WorkWave's webinar. You are watching Metrics That Matter, creating a next generation service business. Thank you so much for joining us. Presenting today, we have Mr. David Levisman, also known as DL here at WorkWave. DL is the SVP and GM of our AI and data analytics business unit, and we're really happy to have him here today to share a lot of great info around measuring and also acting on the metrics that really matter to your business. So thank you in advance, DL, for being here. Before I pass the mic over to DL, just a couple of quick housekeeping notes. Make sure you're asking questions throughout the webinar. So if you look at the bottom of your screen, there's a Q&A question mark. You can pop your questions in there as you think of them, and I'll come back at the end of the webinar to make sure we're getting all those questions answered live with DL here. Also, you will receive a recording of this webinar in your inbox in the next couple of days, so be sure to look out for that. And with that, I'm going to pass it over to DL, but DL, I'll be interrupting you in just a few minutes for some interactive poll questions. So I'll be back. And thank you so much for being here.
Great. Thanks, Shayla. Anyway, nice to meet everyone. Good morning, good afternoon to some of you. And thank you for taking the time to join us today. Background, a little bit of background for myself. I've been at WorkWave for about a year, just over a year and a bit. Background is I've been involved in analytics and AI for quite a number of years, and very excited to be at WorkWave to really focus at helping our field service organizations that work with us or are looking to work with us to help them drive much better results from their business from a perspective of metrics that matter, that are going to help to drive kind of three things that we look at: improved revenue or increased profitable revenue, operational efficiency, and de-risking the business. From the perspective of today's session, I wanted to kind of cover off a couple of topics. From a key market challenges perspective, the way we see in the marketplace is very intense competition. Areas are getting really dense from the perspective of market penetration, but there also is a significant increase in private equity interest in this business. And really, if you think about it, the business is really it's a service business, but it's really geared towards retention of customers and subscription-based metrics. And I think that's really important to understand. That's why there's so much interest in these particular verticals from a perspective of value creation. Some of the big things that are focused from an operational hurdles perspective, things that we're seeing is key focus is route density and expansion. To be able to identify how to optimize your routes, determine the most profitable next zip codes to go to, when to open up a new branch, scheduling effectively and optimizing routes is a constant challenge for a lot of our businesses that we work with today. Another dimension to the business, which really, at the end of the day, the technicians are the ones that are out in the field, bringing revenue to the business and completing the services. And so technician productivity and retention is another very key challenge that is top of mind for a lot of executives that are running businesses, whether you are a 10-person company or a 5,000-person company or anywhere in between. It's always a challenge to basically focus in on being able to provide that. So ensuring technicians are efficient and effective is a primary concern. And at the end of the day, the technicians are your frontline people, and those are the people that are going to really help you, number one, handle gross retention and net retention. In other words, upsell and cross-sell, as well as keeping your customers. And that's really top of mind from that perspective. From a growth and marketing point of view, this is, there's a lot that's happening. It depends on the type of field service. But what we're seeing is it's kind of a combination of digital marketing and also some print marketing, some different types of marketing channels. And the question is really identifying and optimizing your marketing spend to get the best results. And that's also a challenge to help understand who's your ideal customer profile and who do you go after and where do you go and get them from. So that's really another big challenge that we've heard from a lot of our customers, as well as we've been in this industry for a long time and we're pretty deep in these verticals. We really tend to get a great insight into some of these areas. And the last one is the personalization of service. At the end of the day, one of the things that I've heard, but being out in the field talking to a lot of our customers, is really the ability to identify what are the key things that we can actually, create that will differentiate us from the competition. And one of the things that is quite clear is that you sell a service, you want to deliver that service on time every single time, and make sure that you get great customer satisfaction. Because at the end of the day, customers just want to sign up and make sure that the service gets delivered. So the goal behind it is how do you actually leverage technology, analytics, AI, all those various components to really help you identify and create a much more personalized service to create and improve customer stickiness. So with that said, I think that we're going to go to the first poll. I'm going to get Shayla to pop in.
All right, everybody. So we're going to launch a poll. If you could vote or input on this question. How often does your management team review comparative productivity scorecards for your technicians? Are you doing that now daily, weekly, monthly, quarterly, or less, or only when there is a problem? So if you could input your response now, we'll give it just a few seconds, and then we'll be able to share those results. So how often is your management team reviewing those scorecards for your technicians? All right, DL, do you see those responses on the screen?
I do. Daily. So of the people on the call, it's interesting, 31% is only when there's a problem. It's a mix between weekly and monthly, about 23% each, and then daily, 15%. So, one of the things that I will say when it comes to that is that, from the perspective of, technician productivity, one of the things that I think is an important driver in this business is at the end of the day, the real growth in a business is adding more technicians, more routes, and so route value is a key component. So the technicians and only looking at it monthly, I think is way too long to wait. One of the things that we are seeing, companies that are like really getting, I would say, when you talk about retention, the best in class companies that are maintaining the highest retention is about a 15% loss on a year by year basis. The worst case scenarios we're seeing is about a 25% loss in retention of customers. And I think the ones that are looking at getting to best in class are really looking at, maybe not exactly daily, but like multiple times a week, and really focus at holding the technicians accountable for be able to really focus in on what they're supposed to be doing. And so at the end of the day, what gets measured gets improved. So that's really a big metric is route value. So really the total value of that route that the technician, what we call route completion. Are they completing their routes every single day? There are a lot of variables that come into that, with regards to drive time, idle time, time at the job, etc. So those are things that are really important. And so from a perspective of timing and efficiency, a key metric to be able to look at that is extremely important. Ability to compare technicians. How are you doing relative to the best in class? How do you get the technicians to improve? Scorecards are used for that. And I think it can be used in a positive way rather than a negative way. Because at the end of the day, if you're actually measuring it and maintaining it and really have the data at your fingertips, you're going to be able to get much better results because then your technicians know that you care about the customer, you care about the service, and you care about what's going to happen. So from an overall perspective, thinking about efficiency and productivity in terms of money and time, those are the two things that you can control. So time is the only thing you have. And so therefore, that's really important to make sure that those technicians are doing what they're supposed to be doing. So, moving away from gut feeling to data-driven technician scorecards to measure their technician health, the NPS score effectively is really a key component. And what we're seeing is customers that are really at the forefront of driving that improvement in that personalized service, that customer retention, and that delivery of high value is really important and be able to manage your technicians. So the impact is high productivity means more services completed per day, maximizing the output of the most valuable asset, your technician time. That's the only thing you have. The impact on revenue, more efficient technicians can service more customers, on a high, and basically they can also be trained to do upsell and cross-sell, driving more profits. And the impact of de-risking the business is that if you deliver, as I said at the beginning, what you sold, you deliver every single time, your customers are going to stay and not have a reason to move and to leave. So with that said, from the perspective of the technician, I'm going to now move on to the next slide, and I'm going to invite Shay back to do another poll.
Yeah. All right. Thanks for having me back. The next poll, we are moving into quality. So, which range best represents your current callback rate in a typical month? Is it less than 2%, 2 to 5%, 5% or higher? Or are you not actually tracking this metric? So, we do not consistently track this metric. If you could all input now, and then we'll get into the results. How often are you getting callbacks? What is your percentage? There we go. I'll be back.
Yeah. So 18% don't track the metric. Wow. 2 to 5%, about 35%, and less than 2%, about 47, about half. Okay, so that's interesting results, and let me give you a perspective of from a service quality perspective. One of the things that we've seen, and it's really been out now to maybe, I don't know, 10 plus of our, maybe more, 15 now, of our customers ranging in size. And one of the things that I think is extremely front and center is quality. And so one of the things that is important from the perspective of a callback, from a definition point of view, is when the technician must return because the initial service was not done correctly. And this typically results in a free service, meaning the customer will eat the cost. So not only is it critical from the perspective of the callback, because you're going to eat the cost of actually going back out there. You're going to impact the potential route optimization of routes because your technicians are now out in the field having to deal with these callbacks rather than dealing with regular service. Customers are not going to be happy because when they have to have a callback, typically sometimes you get one or two callbacks, and you're finding that customers basically don't go ahead, and they don't stay happy with you. So I think that's the most important thing, is to keep the callback level low. So therefore your customer satisfaction is going to be really high. And then obviously the other thing is the personalized notes, and the quality is important, to be able to capture that information and be able to connect to the end customer. That's also another key component, be able to have that ability to do that, because then at the end of the day, a lot of your technicians are not seeing customers. So the personalized notes coming back from the technician is a key component to tracking really what happened on site. And the other thing is, I think, important from the perspective of, the technician retention, rewarding high-performing techs in relation to low callback percentage is something that we're seeing is an extremely important metric that a lot of these organizations are working on making sure that this is a key metric that they are bringing front and center on the technician scorecard to drive that service quality. Because at the end of the day, when a technician understands that this is something that's been measured and tracked, they're going to be much more conscious, number one, to put the right personalized notes in to the app. And second of all, to make sure that they know that everything is being tracked. So therefore, they want to basically minimize that callback rate. And if they get bonused or you can give them rewards, you're going to end up with a much better result. So an upward trend in callbacks is definitely a red flag when it comes to driving things like callbacks will be a significant cost increase. The impact of your revenue, you could potentially have, it's obviously retention is a key component. So a high callback rate has a big impact on that retention percentage and someone else coming in and eating your lunch because basically the customer's now looking at the next person that's knocking on their door because they haven't been happy with your service. So service quality is a key component. Now we're just going to the next poll. I'll invite Shayla back.
All right. Next poll launching now. For those of you in acquisition mode, if your company were to acquire a competitor tomorrow, how long would you estimate it would take to integrate their data into one unified reporting platform? Would it be less than a month, 1 to 3 months, 3 to 6 months, 6 to 12 months, or is this question not applicable at this time to you? So again, if you are looking at acquiring a competitor tomorrow, how long do you think it would take you to integrate that data into one unified reporting platform? Let's see what we've got.
Okay. Majority of people said it's going to take 1 to 3 months, about 40%, 3 to 6 months, about 13%, and 6 to 12 months, about 7%. So that's it's actually I guess what I'm finding and what we found with regards to a lot of our aggregators that we deal with is that I'll talk a little bit about this from the perspective of a couple of different dimensions to the business. What we're seeing is a lot of companies that are on the acquisition trail of really doing roll-ups and acquiring businesses and rolling them in. There is a time lag to get those customers moved, get that platform moved over and be able to really understand what's going on. So one of the things that we have done is we have really automated and streamlined a large percentage of that to be able to bring that data into a unified, consistent, analytical / reporting platform to allow our customers to get visibility day one into those acquisitions that they're doing, especially if they're already on our platforms. And we've seen that to be fairly impactful. In fact, one customer that was mentioned, it was acquired a company on a Friday, and by the Tuesday, and by the following Monday, they had all the data flowing automatically for that company, so they could do consolidated view of understanding their business. And I think the key thing is that, at the end of the day, why do you want to really get access to that data? Sure, you want to understand the receivables, you want to understand the service levels, you understand, but ultimately, you want to make sure that you protect that customer. And the company you just acquired, you're looking to protect those customers. Because at the end of the day, from the perspective of understanding your ideal customer profile, is another component for the business that is really, I think, extremely important from the perspective of customer acquisition and optimization. So when it comes to identifying, maximizing your lifetime value of a customer, bringing the right customer in at the right time, is involving understanding, number one, who your customers are. Who is your ideal customer profile? And efficiently targeting the market based on those customer profiles. And a lot of our companies that we deal with have multiple regions, multiple zip codes, different profile of customers. And therefore, you have to really target and be very fine-tuned from a targeting perspective. Okay, so the key point behind it is that from the perspective of acquisition cost and targeting the ideal customer, that leads to great lifetime value and retention. And so the other important point is that, if your cost of acquisition is rising and your lifetime value is decreasing, that means you're spending a lot more money bringing in new customers because other customers are leaving. And so I think this is an important point from the perspective of your gross and your net retention. Obviously, you can cross-sell, and that's great. But the key thing behind it is, and there's a low cost to do a cross-sell, but also there's a really high cost to bring a new customer in. That's why that metric I mentioned earlier with regards to the retention rate, on average, the best in class is 15%, and the worst in class is about 25% loss. We all know that every percentage increase in retention percentage is a significant drop to the bottom line. Not only do you actually have to not worry about acquiring another customer, but you're extending the lifetime value of that customer. And I think those are the key components. So from that perspective, the impact on operational efficiency is extremely, if you focus at really driving profitable routes and driving customers not to have the callbacks, you're going to make sure that you're keeping those customers and they're not leaving. And in addition to that, you also, if you're driving to increase your route density in a particular area, you're actually going to get much better profitability. And so then less chance of someone leaving because you can really focus those technicians on very dense routes rather than very spread out routes. And at the end of the day, the risk of losing a customer is minimized by really driving, once again, good quality, tied earlier, route density ties directly to this. Understanding your ideal customer and then going after those regions where you are to double down and find those customers. And we're finding that more and more where companies that we deal with are basically making a real big impact on route density, as well as where's the next best place to put a branch office to expand their routes, but be very targeted and focused. So the more you understand about the customer, the more you're going to be able to do that. So now let's go to the next poll. Shay.
All right, last poll of the webinar. What percentage of recurring customers have a credit card or ACH payment method on file for automatic billing? Do you have 90% or more, 75 to 89%, 50 to 74%, less than 50%, or are you not sure? What percentage of your recurring customers have a credit card or ACH payment method on file? Go ahead and input now. And reminder, we have a live Q&A coming up, so make sure you're putting your questions in that question function at the bottom of your screen, and we'll have DL answer those live.
Okay, so the majority of customers are, I'd say about 60% are between 50 and 74%. About 44% are less than 50%. And some are 90% or more. I'd say for those that are 90% or more, that's fantastic. And that's really, really important. So when it comes to the next conversation, the next point is that from the perspective of credit card on file. customer life cycle. So, the key thing is lead to cash, right? So how do I get a customer? How do I acquire them? How do I get the service level delivered? How do I make sure I get paid quickly, etc.? So incorporating payments and credit card on file is front and center to what WorkWave is doing relative to our finance. We have a big fintech offering within our business, and we very much focused at integrating that offering into our products and tracking that and making sure that we provide the visibility to our customers so they can track and understand first of all, the profile of customer that should definitely have credit card on file, especially for a repeatable service. Everyone, yeah, one-time service is great, but most of the business is valued on repeatable revenue. It's a subscription-based business, so the value you're driving around your business is having that repeatable revenue coming in every single month. Now, credit card on file is important. So getting to that 80+% is a number one goal that a lot of our customers are targeting. But the important thing is making sure that you understand who are the ones that you need to go after to make sure you get those credit cards on file. The other thing is another piece of it as well is these big high ticket items that are often a big service, high profitability, but also could require a customer to have to pay over time. So basically financing options. So those are some of the other areas that we're seeing where we are bringing those kind of value services to our platforms to allow not only be able to execute on those, but also be able to track them and make sure that they are, something that's important, that gets focused on, that you can identify and you can basically deal with. Because at the end of the day, the cash is in your hand. If it's on credit card, yes, there's a credit card fee, but sometimes it's a lot easier to have that cash in the bank than have to go chase. Plus, also, the other piece of it is you get the payment when you deliver the service. You're able to match your payments with your overhead, and therefore everything is much better. Your improvement on your balance sheet, on your income statement, on your cash flow statement, all aligned. So a widening cash gap is obviously a risk that the business needs to manage and maintain. The other piece of it is that we've seen is, and this goes back to a point on callbacks or on quality. So if you have, for example, you miss a service, but you've already received payment for that service, it's still a liability to you, and you still have to deliver that service the next cycle or the next week or the next month. So therefore, making sure that route completions tie directly to the service that you promised, ties directly to the payment you receive. Everything in place is a well-oiled machine relative to your value that you can create within your business. So payments is an extremely important component. And at WorkWave, we are doubling down in that area and continue to improve how we're helping our customers get their credit card on file, manage the payments, financing options, etc. So those are things that we're doing, not only from a data perspective, but also from a services or a feature perspective, or a value-added service that we're adding into our platform to allow our customers to take advantage of that. So with that said, I don't think there are any more polls, but what I'd like to do is I'd like to just close out from a vision perspective with regards to the future. So the ultimate goal for us is to make service so seamless, it's almost invisible to the customer. You show up to do the job, payments automatic and communications easy. That doesn't just come from data or AI or leveraging AI and data. That comes from basically, integrating technology, but delivering the best-in-class technology that's driven by automation through, AI components, modernization components, visualization components. If you think about your cell phone, that's the direction that everyone wants, and that's where we are going in relation to, and we're already there for a number of things that we deliver, but ultimately tying it all together to basically be able to, meet the customer, meet the customer at the at the intersection of what they expect today. And I think as customers are not, I think I know the generation of customers that are buying this kind of technology, this kind of service, are no longer old people like me, right? They are young people that want to basically have everything on the cell phone. They want things easy. They want to just have the service delivered. They want to have it delivered on time. They don't want to have to chase anyone. They don't want to phone anyone. They just want to operate in a very digital world. And that's really where integration of technology, meeting the customer's expectation, and leveraging data and AI is really going to come together. That's where WorkWave is doubling down from a company perspective. And one of the things that I think is important is that we are really very deep in a couple of key service, field service verticals: pest control, lawn care, landscape. Those are the areas that we are very deep in. And I think that that's what will allow us to continue to deliver significant value to our customers. And the one thing I think is important is we don't treat data and AI and components like that as an afterthought. We're integrating it as part of that seamless, one delivery. And I think that that's going to make a huge difference to how you as a pest business or a lawn care business be able to operate and take advantage of someone like ourselves that are really moving in that direction and already there in a number of areas and will continue to drive value in that area. So Shay, are we back?
We're back. Thank you so much, DL. Thank you for all that great content. We do have a couple questions for you. Reminder, pop those in the chat. We still have a couple minutes left that we can answer. But it sounds like someone's still trying to figure out, DL, their ICP. So they asked, what are some of the key data points to track to determine an ICP?
It's great point. So one of the things that we've actually done as part of helping our customers is that we are using third-party data to identify your customer profile, because the biggest challenges our customers face is they only have certain information about a customer, right? So number one is like, what's the financial index? What's the demographic of the house? What's the household look like? And that's the big challenge that a lot of our customers face. And so one of the things that we've done actually, which I never really mentioned, is we've integrated third-party data into our ecosystem, which allows us to help our customers come up with our ideal customer profile and then find lookalikes that look like that customer in the area that they're servicing already. And so really kind of like filling those blind spots. So there are things like household look and feel. Are they retirees? Are they young people? How many kids live in the house? Are the kids at college? What's their financial index look like? What's their property look like? What some of the likes that they have. Those are things that are dimensions that are blind. And I think if you bring those together, you're going to get a much better result. That's why when we talk about ICP, we are helping our customers identify their ICP, tied in those third-party data elements.
Great, thank you. And last question, unless something pops through in the next minute or so, it's around retention, tech retention specifically. So how does tracking tech performance metrics, how do those actually help us retain our best technicians? How have you seen that happen?
Yeah, so I think that's a great question actually, because it's not just about the scorecard, it's how you use the scorecard. So the question really boils down, and that's really a cultural fit. So one of the things that we're seeing is, salespeople are easy. They go out there, you put them on a target, they sell a job, they get paid commission. Great. So one of the things that's happening is a lot of companies are moving technicians. They're out in the field already. They know the customer. They've been dealing with the customer a long time. incentivizing them to upsell. That's number one. Or incentivizing them to get a lead back to the salesperson and be able to track that. So the thing is, you've got to reward your technicians for their performance. But if you're not tracking their performance, there's nothing to reward them on. So therefore, that's a problem. So therefore, what ends up happening is, I think if technicians had, like anyone, what gets measured gets improved. We all want to improve. So if you have a way to measure that improvement, measure that performance, but then from a cultural perspective, give value back to that technician, you're going to retain them for a lot longer because it takes you time to train them. So when you lose them, it's a huge cost to the business. Plus, also, I think the other thing we're seeing is as technicians start to see you sharing in some of the wealth in a way that's measurable, they're going to want to bring other people there. They're also not going to want to leave as much. And that's really why technician scorecard is a key component, but they have to be driven by what you're trying to measure. And if you do that, you'll get a great result.
Awesome deal. Thank you so much. Everybody, that wraps up our webinar today. Again, thank you, David, for joining us and sharing all that great info. Thank you for everyone for giving us a few minutes of your day. And you will get a recording of this webinar in your inbox in the next couple of days, so look out for that. And we look forward to seeing you again soon. Have a great
Great.
day.
Thank you, everyone. Take care.